If you've been scrolling social media, you've probably seen people claim that you can buy a business with no money down. It's simple. It's 100% seller financing. The seller will finance everything. And it sounds amazing, but is it actually true? Does it really happen in real life? In this video, Leo Landis and I talk about and we pull back the curtain on what's really happening in the real world, from business brokers that are actually closing deals, not social media gurus that are trying to sell you a course. And we'll talk about what is really happening out there. So whether you're buying a business or hoping to sell a business, doesn't matter if you're a business owner trying to get in, trying to get out. This information is something you need to know before it can cost and be a costly mistake. You'll learn when seller financing actually works, why 100% seller financing honestly is rarely ever used, and how much sellers typically finance, and really how smart buyers and sellers can use seller financing to make smart deals happen in real life. So don't let internet myths cost you the right deal. Let's get into what seller financing actually looks like, how real people are using it in day-to-day transactions. I think you'll like this one. It was a fun video that I did with Leo.
Comes out.
Hey Trent, welcome
Yeah,
back. Good to
thanks.
see you
Glad to be
again.
here. Yeah.
All right. So today we have a fun topic that we're going to be discussing together. Should sellers finance their buyers? Why or why not? So we're going to have a chat, a friendly debate, if you will. So how often do you, let's just start with this. How often do you run into seller financing on your deals?
Yeah, it's a really good question. So let me start by taking the extreme example, which is some of these guys online come out and they're asking for like 100% seller financing, zero down. How often do I see those? Never. In real life, it's fantastic on social media, but
Right.
a good real business that's profitable, that's making money, and the seller's going to finance 100%, rarely ever. I think in literally at this point, I've done almost 650 transactions that I've actually closed. I've seen it happen one time. And the one time I saw it happen at 100% seller financing was it was being sold to the longtime employee that was literally not blood related, but like a son
Mm,
to the seller. So very rarely does it happen from that standpoint, 100% seller financing. Now, on the flip side, being a little bit more realistic, 10%, 20% seller financing. How often do I see that? I should track that. I haven't actually tracked that to give you a good answer. So just kind of a gut feeling. Probably 30 to 40% of my deals have some type of seller financing
mm,
involved on it.
okay. All right. So let's talk about some thoughts on seller financing, when it's utilized properly. Um, I think of seller financing as a tool, right? What it does, it creates alignment in a lot of cases.
Mm,
And think about it, if you are a buyer and the seller is confident enough about the revenue stream and the cash flow that they're selling to you, it shows confidence, right?
yeah, absolutely.
Um, and SBA lenders love it.
Hmm.
They actually prefer it. They prefer, and the reason for that is because if a seller takes all cash at close, well, obviously it increases the risk profile on the lender who is putting 90%, right? If you're a buyer coming in with 10%, which means that the bank has to come up with 90% loan to
Hmm.
value.
Yeah.
So it helps the SBL deals. It expands the buyer pool. Most buyers love to see the seller, participating on the deal.
Yeah.
And it
Here,
often
here's
increase purchase price.
here's one caveat I'd add to that. Often I'll get buyers that maybe they're not asking for 100% financing, but they want 50% seller financing or something like that. I actually try to steer them honestly away from that much seller financing. 10, 20, 25%. Yeah, maybe. Not just because it's unrealistic from a seller standpoint, but if you think about it, it's not really beneficial to a buyer either, because a seller financing note, let's say someone put 50% down and 50% seller financing. The seller financing is going to be at a much shorter amortized period, 2, 3 years, maybe four, versus the SBA is going to give them 10 years. So the seller financing actually crunches and compresses the amount of cash flow the buyer has because the
Mm,
amortization period is so much shorter typically. And so it's not necessarily to the buyer's benefit to have that much seller financing versus an SBA who's going to one help them, back in and do some validation and do a little bit of due diligence from at least a financing and a cash flow standpoint. Can they service the debt? But it's a much longer 10-year period of time, which in theory frees up additional cash flow for them to live on, for them to expand, to grow, and to build up a cushion versus compressing that cash because they're paying back the sellers on a much quicker note.
interesting that you say that. I'm starting to see. Um, I deal a lot in the sort of the lower middle market, the 2 million plus deals, and I have seen some sellers wanting it more and more as a tax strategy for them, kicking the can down the road. Have you seen that too? Like when they say, "Hey, I'm willing to finance. I stand so strongly by my business that I'm willing to give you automatically a 20% seller financing." Have you
I
seen that
love
kind of
that.
stuff?
I don't see it as much on the smaller size transactions, but when I do, I love that because it, to your point, it gives a big vote of confidence that the seller has no underlying concerns that the business that they're kind of trying to secretly sell before someone discovers some unknown problem. So it's a big boost of confidence. I love seeing that when it comes up.
So if that is so, we understand a lot of the pros of it, but let's talk about Trent. Why do okay if it could be so good for kicking the kicking the tax can down the road, helping the SBA lenders? Why do most sellers hesitate?
Yeah, there's an unknown risk from a sales standpoint. Are they going to get paid? That's really what they care about. Are they going to actually get that money? And it's a fair concern because once you sell the business, you're trusting someone else to essentially protect that income that's going to come
Mm,
in and pay that note off. And so, one of the best, my favorite way to, when we do seller financing, is to set up, there's third party companies that will essentially do auto deposit or auto deduction from the buyer and auto deposit to the seller and do the year end accounting and do all the amortization, the interest, and the forms that go along with it, so that
really?
it becomes an issue where or really a non-issue where the buyer is worried about calling the seller up every month. Hey, remember to send my money. It's now on auto deposit. It's on auto deduction from the
Mm,
seller, auto deposit. It happens on this. They pick a time of the month, the 15th of the month. It just happens automatically until the note's paid off. And every year at the end of the year, this company does all the accounting work to calculate how much interest, the amortization table, what do they have to do from a tax standpoint, and they just give all the forms to the buyer and the seller. That has really helped alleviate some of the risk. It doesn't alleviate the risk. Obviously, the buyer still has to run and operate the business profitably, but it alleviates the risk or the unknown from the seller thinking they have to constantly chase down the buyer. That 2 years down the road, are they still going to be trying to call and say, Mr. Seller, or Mr. Buyer, send me my money.
you know what? You're right. When you were saying that, it totally makes sense. Is when you, as a seller, walk away from the business, you no longer have control of the bank accounts or the balance sheet or the customer. So you have to really rely on the buyer to be judicious enough to send your payment. And you know what? That could be a valid concern. And one thing that I've been, we both were at the conferences where all the lenders go and they talk about this and this topic, this that is comes up a lot, and as a tool to negotiate is a forgivable note.
Yeah.
What has been your experience with forgivable notes? Seller
Yeah.
forgive Forgivable seller notes.
Yeah, they essentially are used as a replacement for what sometimes these buyers hear and learn about online about an earnout. SBA won't allow earnouts, but they
Correct.
will allow a seller forgivable note, which basically means you can agree to a certain point, and an earnout goes up or down. A seller forgivable note only goes down. In other words, if you hit or if you don't hit the benchmark, then it goes down for the buyer. So from a lender standpoint, the buyer's protected because they don't have this unknown upside that the lender can't underwrite to. They can underwrite to the top if the earnout was hit or the adjustable terms were hit. They can underwrite that, which they will and they have to do. And then anything below that is to the buyer's benefit, so it goes down. I've seen that work well when we have a disparity between the buyer and seller as to the price, and the seller knows there's some type of trend or contract or renewal or something that's going to be coming up in the future, and they know the business is going to hit certain benchmarks. And so they feel comfortable doing some type of a forgivable note because if those benchmarks aren't hit, then it's not to the buyer's benefit, but the seller feels confident enough where they know their business well enough, or they know these customers or contracts that are in the works. In fact, I had one that got a really big contract awarded to them from the city. It was actually
Really?
a janitorial cleaning company, but that contract didn't start for a number of months down the road, and then it had a ramp up period. It was a fairly good sized contract, but it was really going to take like a full year for them to hit their full stride of really getting that contract. And it was fairly solid. It was a contract from the city, it was a 36-month contract, and the seller needed to sell for health issues and a number of other concerns. And so they had to sell, but they couldn't quite say, okay, we're going to get this, revenue because it was unknown. The buyer didn't know what was the profit margin going to look like. The lender couldn't underwrite off of potential, and so we structured it as a forgivable seller note based on what we thought, and that way the buyer got the benefit that he only had to pay if those actual projections became historical facts, and the seller got the benefit in that those he knew that contract was awarded and that was going to be coming and it was a ramp up period and it worked out great.
Great. Couple questions for us to discuss right now. One is, how many seller notes have you seen or can you have? I know that buyers ask me like, well, how many seller notes can we structure into a deal? What have you seen out there?
Mm. You know, I guess there's probably no limit. It's whatever buyer and seller agree to and then have the attorneys draft it up. I have not seen more than two. Um,
Yeah,
typically
I
we'll do typically it's just like one seller carry note, but sometimes what we'll end up doing is two seller carry notes, seller note A and seller note B. One's on standby, one's not on standby, and we're kind of playing around with the two notes when one is being paid versus when isn't, the other one isn't. But I've never seen one or personally been involved with more than two on a transaction.
Yeah, my limit is two. I've seen it, and more often when I see two happening is we are a because of the post-closing liquidity, and depending how much working capital is required, we put a deal together in which the bank, we took a one seller note for 5% of the transaction that was on a 10-year standby, and another 10% note tied to some other measurement on a forgiveness part. So there were two notes, one regular amortization and the other one on a 10-year standby, and that's how we put it together.
Yeah, yeah, similar.
Which
We've done similar things.
that that's pretty. I mean, that's probably what you've seen as well, right? But usually
Yeah.
one tied to the down payment, the equity injection.
Mm-hmm. Yeah.
Okay. Now let me ask you this: speaking of de-risking a deal where there is a forgiveness attached to it. Now I was surprised to learn that there are circumstances in which it's not just revenue downward trends, but it could actually be tied to employees. You know,
Yeah.
if a key employee leaves in the next 12 months or two people walk away as a result of A, B, C, and D, then formula would be this much will be shaved off of this seller note. Have you seen stuff like that
Yeah.
happen?
I've done not a lot, but I've done two or three deals like that where they really are true key employees, and there's both a discount on the purchase price if they leave, and the way that the buyer has tried to incentivize the employee to not leave, that they're not underwriting on just some random employee and hoping they're going to stay, is they'll give a bonus for the employee staying and hitting that benchmark, like 12 months or whatever it happens to be. And so
Mm,
it's gone both ways. It's a discount if they do leave, but if they stay, not only does the seller get paid, but there's some sort of bonus incentive to the seller to actually know. So in other words, the seller, or I'm sorry, the key employee usually knows there's some sort of a, for lack of a better word, bet on them staying, and so they incentivize them to stay.
great. I like that. All right. Misconceptions. Trent, I'm sure that that there are misconceptions that you've heard tied to buyers or sellers. What misconception could you clear up regarding buyers when it comes to seller notes?
Yeah, big one is again, I deal with a lot of first-time buyers, and so a big misconception is seller financing makes a bad business better or good. Just because a business is offering some type of seller financing doesn't mean it's good. Not all businesses should offer seller financing, but it certainly doesn't make a bad business better. In often cases, like I mentioned before, because it's a much shorter amortized period, it could actually make things worse because it crunches down the cash flow. So that's a big misconception is just because someone's offering seller financing doesn't necessarily make it any better or more positive than they should be underwriting on their own, regardless of what the terms of the business are.
Great, great. I'll tell you one from sellers is a lot of sellers, particularly if this is their first transaction, and I deal with a lot of first time sellers, right? Is that seller financing is inherently dangerous.
Mhm.
And they just, I must take all cash at close. I refuse to do any seller financing. And sometimes to their detriment. And even the bank will say, hey, look,
Yeah.
this deal has some blemishes. It's not perfect. There are some issues 2 years ago with the DSCR that fell below 1.3 or ABC, and they just refuse to do it. And I'm here to tell you that it's not always dangerous. And especially for the point that you made earlier about if there is a third party is going to be handling the money piece, so you don't have to worry as a seller collecting your payments once they're due, that is something that does help. So
Yeah.
yes, it's not dangerous if done properly.
Yeah, and here's another misconception. Again, on my side, first-time buyers, often there's a misconception is if the buyer doesn't have enough money to get down, they can make up for it with the seller financing. And I'm
Mm,
a little bit leery about that. And the reason I bring it up is let's say a buyer wants to buy a business. Great, fantastic. It's so much easier than starting a business, and they should absolutely pursue it. But if they're looking at a business that's too big, and they're stretching themselves and they're relying on seller financing to kind of bridge that gap to get into something too big. What I worry about is often first time buyers can get in over their heads between stretching their down payment, getting an SBA loan, and doing some seller financing for the balance. And all of a sudden they're at 95% loan to value on this
mm,
business. That makes me a little bit nervous because the seller may have a fantastic business. They're operating without any debt, often the case.
yeah.
They're 20, 30 years operating in business. And they can weather a slow season, a slow month, a key employee leaving. But when first time buyers get in over their head and they leverage themselves so much with debt, the margin for error becomes it becomes such a high risk venture. Remember, the whole reason they're looking to buy a business rather than start a business is they want to lower and decrease the risk. They want to buy something that's stable and cash flowing. But
Good point.
they invert that risk if they stretch themselves too far by leveraging too much debt. All of a sudden, they've just increased that risk significantly because they now can't weather a slow season or they can't weather a key employee leaving, and that makes me a little bit nervous.
Well said. Oh, I think you said it perfectly. There's nothing more for me to add. I think Grace, well said. Now let's kind of bring it home and some final thoughts. Trent, I'm going to ask you some questions, and you just tell me what your thoughts are. Ideal seller note size. Thoughts?
10 to 20%, ideally.
Okay. Ideal terms?
2 to 5 years,
Okay.
somewhere between 6 to 10% interest.
Okay. Personal guarantees?
I have never seen it not happen. So buyer always has a personal guarantee. They're signing a promissory note, a security agreement. I've never seen it not happen without a personal guarantee. Now,
Thank
I
you.
don't mean to derail you, but here's something that really interesting just made me think about it. If a buyer is worried about the personal guarantee, which is almost always required on a seller carry note, but it is definitely required on the SBA if they're getting SBA financing. There is a new, and we can maybe do a whole separate discussion of this just to kind of tease it for maybe a future. There is a new insurance product that's been around in Europe for a while, but it's new to the US that covers its personal guarantee insurance. So it covers
Really?
50% of what their liability is to the SBA. So they can get a personal guarantee insurance policy that protects half of what they're guaranteeing to the SBA.
You're kidding. I didn't know about that. Is this
Yes,
a
brand new to the US.
I want to, well, you know what? We may need to do something like that because that is the first time I hear about it.
Yeah, yeah,
Wow.
it's neat. I've got 3 buyers that are doing that right now with their SBA loans.
That's awesome. All right, couple more things. Standby or not standby.
It depends on if the buyer needs it for equity injection, which I prefer them not to because that means they're probably leveraging a little bit too much than they can afford. But on the same time, it's really helpful for a buyer to delay those payments and give themselves some wiggle room. So, yes to that. It could go either way.
Okay, yeah, I already answered the interest rate. You did say 6 to 10%, which is I agree with that. Somewhere in the middle of that, probably below. It's going to be a hard push below 6%, 5%. It may not fly.
Yeah,
Let's just. I always think about what is fair and equitable on both sides, and 5% doesn't seem fair and equitable to me.
yeah.
All right. So, hey, if you're watching this video, please leave us a comment below. Tell us about what you want us to do next. Any videos, any breakdowns. I think, Trent and I would love to be able to assist as many people that give you real knowledge from our years of experience. With that said, any final thoughts, Trent?
No, I enjoy doing these videos, and hopefully it's good education for the buyers and sellers out there. So thanks for having me.
Thank you so much, Trent. All right. Goodbye, everybody.